Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. This episode features Dan Katz and Stephen Miran of Amberwave Partners. Dan and Stephen have very interesting backgrounds. Stephen contributed to implementing the CARES Act programs. Dan was a member of the National Security Loan Program Credit Committee as well as the Airline Loan Program Credit Committee. Together, those committees oversaw more than $20 billion of emergency loans. They joined me to talk about their firm Amberwave Partners and their concept of JSG Investing. That stands for Job Security and Growth Investing. I enjoyed this conversation very much and believe you will as well. I think that you should pump some US national anthem music for this one. But all kidding aside, I really did enjoy this very much and think that they have some unique things to say. So I appreciate them coming on the show. This episode is sponsored by Bastiat Partners, a boutique investment bank. Bastiat's founder and managing member is Nader Afshar, a fan of the pod. When he reached out to me, I wasn't sure whether I wanted to be sponsored by an investment bank that I'd never heard of. A few conversations and a couple due diligence calls later, and I'm happy to be associated with Bastiat Partners. Nader is described as a connector, high integrity, a low-key version of Byron Trott, and a rare investment banker that focuses on the alignment of interests and incentives. So I appreciate him allowing me to do some due diligence on him and his firm, and I appreciate Bastiat's support. As always, none of this is financial advice. All of the information contained in this program is for entertainment purposes only. Please consult your financial advisor before making investment decisions and do your own due diligence. All right, everyone. Thrilled to be joined by Dan Katz and Steve Miran today from Amberwave. Guys, do you want to, I don't know who wants to start, but rather than me do the intro, because I don't want to mess it up, do you want to tell your firm name and your backgrounds and how you came to your investment philosophy? I mean, I know that that's kind of a lot, but let's kind of keep that, as tight as possible, and then we'll start the conversation because I find what you guys do very interesting.
Great. So thanks so much for having us. We're super excited to be here. We, the three of us, the co-founders of Amberwave Partners, really met at the Treasury Department in 2020 when we all found ourselves together at the Treasury to help implement the fiscal policies that really shored up the economy and prevented a depression and got the sort of economy roaring back to life during the COVID pandemic. It was a honor of a lifetime to be able to help out like that, and we were super proud of the work that we did. And when we came out of Treasury, we thought, we'd all been in finance for years before that. I was a portfolio manager at a hedge fund. Dan was a banker at Goldman. Our third partner, Tom, was in private equity for many years. And we thought, rather than going back to what we were doing before, hey, wouldn't it be fun to do something totally new and totally exciting, very different? And we looked around at the financial universe, noticed that one of the biggest changes in the last 10 years was the rise of impact investing, particularly ESG investing, which stands for environmental, social, and governance-based investing, and that this was massively popular and that there was enormous demand for products like this. We looked around at the range of products that are out there, and lots of folks doing ESG stuff, but many of them are doing stuff that's very similar to each other. And we thought, it's really great that people are doing impact investing. We don't see the values that we think are the most important values out there represented. And so we want to try and do something new. And so we came up with what we call JSG Investing, which stands for Jobs, Security, and Growth. And so what we do is we try and direct capital to companies that are having, in our opinion, the most positive impacts on the country by creating jobs so that people can have thriving lives and careers and communities all across the country, contributing to security broadly construed. That includes supply chain security, cybersecurity, information security, national security, all those things, and contribute to economic growth, because economic growth is really how everybody can benefit and lift up into prosperity into the future and create the basis for broad-based prosperity and flourishing of a country as a whole. And so that's what we decided was super important to us, and we want to create an entirely new way of impact investing, and that's what we've set about to do.
Dan, do you have anything to add?
So
no is fine.
Yeah, no, the one thing I would add, just to slightly elaborate on Steve's great points, is that really when we think about the DNA of our firm, we're really trying to do two things, right? So one is to put at the heart of our firm some of the judgments around public policy that we have experience implementing as economic officials in government, and that we know work and lead to better outcomes in American communities. But just as importantly, we're trying to instill within the job security and growth, the JSG investing style, the importance of returns for investors. We don't think you have to choose between doing well and making an impact in your community. We think there's very substantial evidence actually that shows that the kinds of factors we're looking for in companies will also tend to be associated with companies that outperform over time, right? So companies that have healthy labor practices tend to outperform in our view because they're able to have more productive workforces, they're able to attract more talent, they're able to grow and scale more quickly. Companies that have supply chains that are more US centric, right, that are rebuilding their manufacturing and sourcing here are going to be less exposed to geopolitical shocks, whether that's from a pandemic or whether that's from Russian invasion of Ukraine or any other neighbor. And so we actually think that this strategy is both vital to returns and to impact.
So when you're analyzing the JSG characteristics, is it fair to say that it's from a US centric lens? Or is it, like, does it include Canada? Is it just US centric?
Absolutely. It's just US centric. In fact, the letters USA are in the name of the ticker of our ETF, which is IUSA, right? And we're focused on the impact on American communities, right? We want to create jobs in communities all across the country and enforce the security of folks all across this country. And, we think that people in Canada should be pursuing similar, similar products, and people in Europe should be pursuing similar products, right? But, the three of us are Americans, and we want to do, sort of try and help people all across the country.
Yeah.
One thing I'd add is, on the kind of international dimension, I mean, Steve's exactly right that we're focused on investing in U.S. companies, rewarding companies for investing back in the U.S. But when we evaluate, for example, the impact of a company on U.S. security and the security of our supply chains, we do look at different sources of foreign feedstocks differently, right? So a company that sources its inputs from Canada or from Mexico is going to score a little bit higher than a company that sources its inputs from Russia or from China or from Southeast Asia, because those supply chains are much more vulnerable to disruption. So we do distinguish, amongst the markets internationally in our scoring process, but it's all focused on impact here in the US.
That makes sense to me, especially given what's going on in the world right now. One thing that I was hoping that you could help me understand is what, if you don't mind talking about current events a little bit, what exactly goes on when we sanction a country like we did to Russia, and how does that, part one of the question is what's the mechanism to do it, and part two is I don't know how to contextualize what we've done to Russia relative to what we've done to people or countries historically. How big of a deal is this? Maybe a silly question, but it's the one I have.
It's certainly not a silly question because it's fundamental to understanding what's been happening in markets over the last few weeks. So, maybe I think it's just helpful for a lot of folks out there to step back to the basics and really look at, what a sanction is and what the transmission mechanisms are, right? So sanctions are a tool that governments can use when they want to achieve an objective. The primary objective is putting pressure on an adversary somehow, right? So when you read about blockades in history, right, naval blockades in Greece in the 4th century BC, those are a form of sanction. Now we have much more sophisticated tools that operate through highly complex transmission mechanisms in the financial sector, but it's still fundamentally the same idea, right? You're trying to make it difficult for an adversary to do business in order to achieve a change in their behavior. So when we, the US or any international jurisdiction, when we announce a sanction, what that means is that the U.S. or any other jurisdiction has actually changed their law to prohibit their people who are subject to their jurisdiction from doing certain kinds of activity with the foreign government, right? So because we have a highly interconnected, highly developed financial system now, the tool has moved from a naval blockade to a financial blockade of types. So the thing that's often forgotten in that development from naval blockades to financial blockades is that now actually the private sector is the mechanism through which economic pressure is delivered, because it's ultimately the private sector that implements sanctions. So, over the last 3 weeks, as we've seen sanctions ratchet up, and I'm happy to cover the impacts. Really, the impacts and contextualize, just how significant it is. Really, what we've seen is that the private sector has had a hard time getting their head around, what is prohibited now, what may be prohibited in the future, what may be allowed but present reputational risk. And that's why we've seen so much uncertainty, in things like Russian oil sales that are explicitly carved out of the sanctions, right? That governments explicitly want to allow. You've still seen private market participants step away from doing that kind of business because they're worried about reputational risk, and they're worried that governments are going to turn around in the future and change things. So, really the sanctions mechanism is immensely complicated and involves this dance between governments and the private sector, which is actually not that much different how many other markets operate. And so it's fascinating to watch this market-based cooperation mechanism generate financial impacts on adversaries that sometimes are exactly what governments wanted to achieve, and other times are different.
Yeah. It's been interesting from my perspective or whatever, and this is like way outside of what I normally pay attention to, but to see a company like BP just say, okay, we're going to divest of our stake, right? And to come out and pre-announce that and not, if you say something like that, presumably you're selling to a buyer that knows that you're a forced seller. It's as if the economics of getting rid of it almost didn't even matter. But I presume the internal conversation is, well, the political goodwill that we will accumulate by selling this exceeds, whatever cost we're going to write it down. So it's been a wild thing for me to watch.
Yeah, it's a great point, right? That's a very strange dynamic that gets created. Just to push it a little bit further, think about if BP or some other Western firm is going to, divest themselves of their interest in certain Russian energy products, and the most likely seller is just to hand the shares back to the Russian firm, which is actually a massive windfall for the company, right?
Yeah, in a perverse way, it puts wealth back in your quote unquote enemy's pocket, right?
Exactly right. And look, we have seen governments in the West try to be thoughtful about the way that they're encouraging divestments. So built into some of the orders to divest and sanctions related prohibitions are prohibitions on selling of sanctioned assets to sanctioned parties, right? So selling back to the target, because you don't want to create windfalls. But this is a highly the Russian. Just to back up, you asked a little bit about where this kind of fits into the overall scale of sanctions and how significant are the actions that are taken. The actions that were taken themselves, like the legal sanctions that were taken, are not unprecedented. These kind of measures have been taken against other jurisdictions, other countries, and actually more aggressive measures have been taken. What is completely unprecedented is how interconnected the target is to the global financial system, right? The Central Bank of Russia had over $600 billion USD equivalent in reserves prior to the freeze on Russian central bank reserves that was announced about 2.5 weeks ago. The entire Iranian economy, which is probably the other most sanctioned, which probably represents the height of aggressiveness of sanctions, was only $550 billion when Treasury started moving very, very aggressively against the Iranian economy, the Iranian central bank, the Iranian oil sales in 2012. So the scale is just vastly, vastly different, right? Russia is vastly more interconnected into the global financial system, which is precisely why when you roll out these sanctions, you're going to encounter, in like just enormous amount of permutations of various financial structures, and it's very difficult to understand exactly how the sanctions will fit in all cases, which is why you end up with some of these paradoxes like the one that you pointed out, where you may end up, if you're not careful, delivering a windfall to the person that you're trying to generate pressure on.
And these worries, these wonders sort of spread throughout the entire financial system, as well as folks aren't sure who's going to be stuck with obligations that aren't money good, right? And so you do see, some signs of funding stress poke up here and there in financial markets as people are unsure about their counterparties making short-term payments, right? That's the type of thing that happened in 2008 during the financial crisis. I mean, there's $170 billion of foreign exposure to Russian assets, equities, and bonds, right? You can't just, excise that from the global financial system with zero consequences. So everyone's trying to figure out exactly what those consequences are. And so far, it seems like it's not too bad. But you are seeing, like a little bit of pressure here or there.
Yeah. I think where you're also seeing pressure is in the commodity markets, and it's very hard for me to understand how fungible commodities are when the West is sort of blocking Russia from doing anything. I mean, I'm not being specific or precise, but this is how I think about it. How many of those commodities just go to China and India? How many, like in theory, you could just move something to a different jurisdiction and then the aggregate supply doesn't increase or decrease. But it seems as though the logistics and the supply chains are completely messed up from a commodity standpoint, and they already were pretty tight as it was. So this is creating quite a confounding series of events.
Absolutely. And commodity prices are really the one way that Putin has to strike back, right? We can control the banking system in ways that hurt him, right? In ways that Dan was describing a couple minutes ago. Driving commodity prices higher are his way to strike back, to put pressure on Western governments, and that's his only real meaningful tool.
Yeah, and just to give you kind of our house view on what you've seen in the commodity markets over the last couple of weeks, it's really been a complex story, right? So immediately following the invasion, you saw a huge run up in a variety of markets. Some, were technical driven. Obviously, there's been a lot of attention on, the nickel market, for example, which is kind of a one-off, esoteric kind of issue driven by a short squeeze. But the oil market's a pretty deep and liquid market, and there may be some technical factors driving the price rise we saw. But primarily, it was a worry about the status of future supply. Over the last week, you've seen a dramatic reduction in oil prices, which to us is kind of driven by two things. One, certainly it's going to be driven by questions about Chinese demand for the next year and extending out further as a result of some of the real, very serious questions that are getting asked about the how sustainable their zero COVID policy is going to be, particularly as we see infections on the rise, both in the mainland and certainly in Hong Kong, which has been very, very severely impacted. And if you remove a large chunk of Chinese demand for the market, even if it's difficult for Russia to supply the market, well, maybe the market's not so tight after all. But the other very strange phenomenon is that Western governments, as I mentioned earlier, have been very explicit that the sanctions do not apply to oil. Right, the U.S. is kind of stands alone in having announced a ban on U.S. oil imports. But the U.S. very specifically still allows U.S. financial institutions to finance foreign purchases of Russian oil products. So governments have not tried to impose an embargo on Russian oil and keep Russian oil off the market. But what you've seen is that the market itself has said, you know what, there's a lot of reputational risk to be seen, funding Russia's invasion of Ukraine. By the way, governments may change their mind in the future. You saw this a little bit with the U.S. oil ban, right? What essentially happened is that the Biden administration exempted the purchase of U.S. purchases of Russian oil and refined products. And then Congress moved to act, right? And the market actually was right about this. The market anticipated that Congress was going to act. And so they had already stopped purchases prior to the action being announced. And so the real question for the oil markets, we think, is going to be how long this self-sanctioning mechanism can last. Because the longer it lasts, the more difficult it's going to be to maintain, right? For now, there's some question about demand in certain markets, particularly China. There are inventories, even though they were fairly low coming into this crisis, right? So there is a little bit of give in the market. But if this persists much longer and there's no change in Russia's aggression against the Ukraine, we're going to get into a situation where if the self-sanctioning persists, you're going to see the market tighten even further, likely going to see prices go up. And then there are only two options. One, you can bring more supply to the market, which can't happen quickly. Or two, you're going to need to ration and reduce demand.
And all this really, for us, underlines the importance of why it's important to pay attention to your supply chain exposure and why we make such why we put so much effort into looking at the supply chains of the companies we invest in. Because when something like this happens, one of the best performers in our portfolio since the Russian invasion began has been a company called Mosaic, right? And they're a fertilizer producer, and they source all of their inputs in North America, and they own or control all their subsidiaries, right? Russia's one of the top sort of producer of inputs into fertilizer, which of course is absolutely essential to keeping the world fed, right? So it's super important to be aware of the supply chain exposures you have, because obviously Russia doesn't invade the Ukraine every day, but it seems like, every year there's several geopolitical volatility events where something happens to disrupt supply chains, and it's a significant driver of outperformance. And it has been a significant driver of, the Russian invasion has been a significant driver of outperformance for our fund.
Yeah, well, especially, Mosaic is what, potash primarily or something, and that has just ripped. So I would imagine that's a nice position to have. I think about, so is like CF Industries something you guys own too? Yeah. So that's interesting. So you're looking at what are like base materials that supply in these two examples. I think you're looking at like what are base materials that support our food infrastructure and make America sort of self-sustaining potentially in this area, right?
Exactly. So when we're looking at materials companies, we're looking at, sort of food companies, whether it's in a consumer sector or in a materials sector, right? Or industrials, no matter what it is, we're looking at where are their inputs coming from, right? Are they reliant on Russia for their nitrogen, right? Or are they actually, sort of sourcing that nitrogen in the US and Canada, right? Because obviously, there's a big difference between the two of them in terms of geopolitical resilience.
Yeah, and just to maybe give you a bit more context of the interplay between this, job security and growth, these JSG factors, and our investing strategy. For us, JSG is really akin to, ESG, right? It's an investment philosophy, but you can have different strategies within that philosophy that are designed to achieve different outcomes. So in our existing fund, the IUSA ETF, the strategy there is to provide a product that broadly represents the market in the sense that it has the same or similar sector weightings that the S&P 500 or any broad market measure is going to have, but within sectors to pick the top performers on job security and growth as a way to isolate for job security and growth outperformance rather than being overexposed to energy or materials or any other particular sector. So when we think about IUSA, really what we're trying to engineer for is JSG Alpha. And that's what we've seen in the context of the geopolitical uncertainty since we launched the fund in late January. We've seen about 200 basis points of alpha generated, and we're recording this on March 17th. And so that's about what we'd expect in terms of the JSG Alpha, right? But obviously, if we owned 100% energy, we would be, way overperforming that. But that's not the function of the IUSA product.
Okay, so to just repeat what you said to me back to you, you're trying not to pivot too much from sector weightings, but you're trying to identify the strongest US focused JSG companies within each sector?
Yeah, that's for the IUSA ETF. We may have subsequent
Okay.
products and other strategies in the future that will maybe look like sector focused funds where you choose only the best, job security and growth performers within a sector. But for IUSA, we're really trying to provide a diversified, large cap replacement that's focused on JSG Alpha.
Within the jobs portion of this, do you distinguish between, a company that creates 1,000 jobs, but they're not particularly high skilled versus a company that maybe does 20 jobs, but they are high skilled? And how do you weight sort of those factors?
Yeah, absolutely. That is 100% stuff that we look at, and ideally, what we want to see is we want to see job creation across the skill spectrum, right? Obviously, all else equal, high-paying jobs are better than low-paying jobs, right? But we also want to make sure that there are opportunities for entry-level employees, right? For people to create an American dream straight out of high school, straight out of college, right? And then opportunities for training and advancement along the career ladder, right? We want to see people stay in firms for long periods of time and get promoted internally and make careers and lives for themselves and their families, right? We don't want to see churn of entry-level workers where you're just hiring and firing, sort of unskilled labor without ever giving them skills. Right. So we look at all those things, and there's no, formal weighting mechanism, sort of thinking, one high paying job is worth X low paying jobs. Right. Because what we're looking at is a more holistic approach to the company's treatment of its workers and provision of employment opportunities for everyone.
The perspective that we're coming at when we look at the job score is really the perspective of the holistic health of the labor market. Right. I mean, that's certainly what we always tried to focus on during our government service and other contributions to public policy, is making sure that there's broad-based prosperity, right? Because you don't want to see gains accruing just to one particular social group, one particular geographic area on the coast, right? What you really want to see is gains across the sector, and particularly for those who need the most help. And so when we look at companies on the jobs factor, as Steve said, we're really looking for a diverse array of positions being created, and in particular in areas that may be economically left behind, or for populations that have had relatively less economic opportunities. So big bonus points. So big bonus points if you're creating jobs in rural communities for folks with just a high school degree, right? Same thing with respect to the inner cities. So a job like that is going to be is probably going to mean more in our scoring than just another software engineer in Silicon Valley or New York.
Yeah, I like that, because I think maybe my tone may have, I'm not sure that it conveyed what I was thinking in my head. I actually think right now, with all the inflation, I would probably overweight raises to the lower income segment of the population and weight higher some of the more creation of lower paying jobs than I would necessarily taking care of those that have sort of been winning, for lack of a better term, for a long time. That's just my bias right now.
Absolutely. I mean, when you think about who needs help, right? It's exactly those folks that you were describing. I mean, when I think about what would I think of as a successful product, right? Look, ESG is a tens of trillions of dollar industry, right? Ecosystem. We'd love JSG to get to a size like that where it can have impact, right? And for this to be a successful product and to scale to the point where you can have that type of impact, I would love for JSG to lower the cost of capital for companies creating jobs in the US, as opposed to taking your capital and shipping it abroad and creating jobs in, China or Malaysia or Canada or Mexico or anywhere else, right? And think about the archetypal factory town where the factory shut down, and now the main source of economic life in the community is gone for decades, right? It would be so wonderful to be able to lower the cost of capital for creating jobs so that more companies will revive those factory towns and invest in communities that don't have that economic lifeblood, and where frankly it is now very cheap to produce and very cheap to do stuff.
Yeah.
Right. That's what the long-term goal is going to be.
Where I think JSG and ESG could probably marry is in the idea of providing childcare. And I was at a charity event last night, and somebody said, how do you help how do you help somebody a family that's struggling? And that right now, that's my answer, just because I think it's got to be so difficult to raise a child and be able to have two people have a job. So I don't know. It's
Absolutely. Absolutely. I mean, look, I think there's actually a significant amount of overlap between JSG and ESG. We don't call ourselves an ESG fund, but there's certainly ESG folks who love our product and who love what we do. And childcare is an important part of how you're treating your workers, right?
Yeah.
And it's an important part of your workers being able to start their own families and live the American dream, right? 100% that is something that we care about.
Yeah. I think my opinion on ESG is that it's just been used for marketing, but I think that when done right, I bet that there is a ton of overlap. I sometimes wonder if ESG, and I don't know this, but like, does ESG exclude someone like Northrop Grumman? And if so, do they actually understand what makes America secure? I would argue probably not if they're making those kind of exclusions, but it's my own opinion. You guys don't need to comment, or feel free. Either way.
I don't
want to put you in a weird spot.
I would like to comment. And actually, I'd like to push back a bit on your point that, ESG has really just been for marketing purposes.
Feel free.
If ESG really was just a marketing spin and had no impact, then you would find it much easier for shale companies to attract financing right now. But the reality is that, the fossil fuel industry has been hugely impacted in terms of their access to capital as a result of the proliferation of ESG through the public markets and even the private markets now, right? I mean, you've seen a number of very, very large asset managers make pledges that they're not going to invest in fossil fuels as part of, their flagship buyout funds. And so ESG, from my perspective, actually has had a big impact on the market. Now, I think there is a marketing issue, which is that, I think ESG sometimes overpromises, right? Impact investing, incorporating your judgments into allocation decisions is never going to solve all of the world's problems, right? And I think sometimes, some folks in the ESG ecosystem gotten a little bit ahead of their skis and implied that this is a solution to climate change, to solving all the world's problems. But it's not, and it never will be. What it can be is make a difference at the margin. And if the impact is better than the counterfactual, if you didn't have ESG, then it is making a meaningful contribution. It's just important to line up the marketing with the actual impact.
Yeah, I don't actually disagree that it's had an impact. I'm just not sure that I necessarily agree with some of the externalities, but whatever.
And for sure, there are times when ESG doesn't deliver on its promises to investors and investor portfolios, right? I mean, you've seen that this year as all these ESG portfolios that have excluded sectors like energy, like defense, right, have really, really lagged the rest of the market in some senses and times, because they haven't had exposure to some of the hottest sectors, right? That's failing their investors, right? And that's significant part of the reason why, when we created IUSA, we decided that we weren't going to play with sector weights, right? Because we didn't want to run the risk that, we'd sort of deliver significant underperformance to our investors by ignoring parts of the economy. I mean, think about, like the IT sector, right? The IT sector, it's hard to find, sort of mega capped software companies that sort of score fabulously on JSG criteria, right? Obviously, you can't cut out exposure to mega cap software.
Do you mind
companies.
Just why do they score poorly? I don't mean to cut you off, but I know why you can't keep them out. You're taking a ton of performance out of the index, but why do they score poorly?
Well, not necessarily taking performance out, but sort of, because there are times when they underperform, like they have in the last few days, right? But leaving yourself vulnerable to significant performance divergences, which is just what we think our investors wouldn't want in our first product, right? In terms of why we leave them out, I mean, there's it would be job numbers, right? It would be security numbers. And when you're looking in the IT sector and you're thinking about, okay, I care about security. Well, there are companies that focused explicitly on security. Companies like Motorola, sort of their security firm, right, is in the S&P 500 in security, right? A company like, and I guess this is communication services, not IT, but like a company like like Facebook, right, Meta, Like, it's really hard to make an argument that that contributes to, to security in any real sense, whether it's supply chain security, national security, sort of security of communities, right? And so it's really tough to make an argument that a company like that sort of should have a strong JSG representation, right? So it's because you're unable to give high scores to these companies as a whole, but you still have to include some representation, right? You wind up taking, the best of the sector, and that sort of leads to, IUSA essentially having a beta of just about 1, right, to the S&P 500, like 1.005, I think, last time I looked. Which means that all the outperformance is just pure alpha, which of course you would expect in a product that matched the sector exposures of the S&P 500 almost exactly. But back to, ESG, I mean, yes, there have been significant times when ESG has not lived up to its promises on performance. And that, sort of may to an extent be a marketing effect. And we've also seen a significant, greenwashing concern, right? There was the Deutsche Bank scandal earlier this year, right? Or was it late last year, in which, it turned out that, they were advertising they were taking all these ESG actions, and it turned out that they weren't. They were just sort of saying ESG and climate everywhere in their literature, but not actually putting their money where their mouth is, right? So, there's concerns about greenwashing in ESG in terms of, are these guys actually doing what they say they're doing? And, we think JSG really provides a solution to that. At the end of the day, what greenwashing is about, concerns over greenwashing is about, are concerns about impact measurability, right? They're about, does the product that I'm buying or that I'm investing in really tie back at the end of the day to really moving the needle on any of the ESG issues that I really care about? Is it really moving the needle on climate change? Did climate change alter its course whatsoever because I bought an ESG product? Or was climate change totally unaffected by my ESG actions? That's a significant question, right? With JSG, you don't have that impact measurability problem because we're counting the jobs that you create, right? We're counting the jobs that are created in companies in the portfolio. And every time there's a news release about job creation or job destruction, we're reading it. We're incorporating that into our scorings. Every time a company is releasing data on what it's doing with its employees, we're reading that. We're incorporating that into our scorings. And so the fact that people have jobs now that didn't have jobs last week or last year or 2 years ago, right? That's, we feel a concrete improvement in people's lives in a way that you don't really have with the impact measurability, sort of in problems that people have in the ESG space.
Do you mind defining greenwashing just so we all are on the same page?
Sure, I can take that. Yeah. So greenwashing is, a real term of art that you see thrown about in the ESG space. And just to kind of, break it down at a fundamental level, what it means is that it means when someone is advertising a product as green, right? Or as having some kind of environmental impact, but there's really no way to substantiate that the company, that the fund or the product is actually having an environmental impact. So, you see this a lot in like certain ESG indexes that market themselves as green or as ESG or as, consistent with the Paris Accords, but that then hold, a whole host of fossil fuel firms in the index. And it's a phenomenon that you see in the ESG space from time to time. Can we also just return quickly to a point, Bill, that you raised that I thought was really interesting, was this issue of the externalities associated with ESG and, what the impact of those externalities is. When we take a step back and we looked at the impact investing market, what you see is that ESG is really dominant, and ESG is primarily driven by, a relatively narrow set of issues that are really oriented around the environment more than anything else. And so because ESG has become kind of a catch-all for all impact, right, or all things investors should care about that aren't traditional financial metrics, in our view, what you see is, an imbalance on, a bunch of other real critical impacts that investors should be thinking about, right? And so if all investors are focused on is the environment, you're going to create externalities when you say, have Exxon divest from certain of its fossil fuel interests. That may have a climate impact, but what about the jobs that are left behind, right? What about the American communities that depended upon some of these traditional industries, right? What does it do for U.S. energy security and our geopolitical vulnerability to Russian economic coercion, right? What does that mean for the future path of inflation and how American consumers are going to be able to, feed their families and continue to maintain standard of livings in the face of what have been declining real wages as a result of the inflation problem we have, right? And so, really, what we're just trying to do is to add some additional perspective into the market to exist alongside of ESG, right? That people should consider alongside environmental, social, and governance decisions in order to create more optimal outcomes for American communities rather than just focusing myopically on ESG.
Within the growth context, I'm going to ask a broad question, and I hope it's okay. I don't want to put you guys in tough spots, but like I'm thinking about a company that is investing a lot. So let's take Amazon, for example, right? Definitively not playing a margin game, growing, always hiring, always reinvesting. Arguably trades at like a valuation that appears optically high relative to current free cash flow, right? Because there's so much investment versus, a company that's maybe cheaper but isn't growing as much. How do you make those trade-offs in a financial product?
Yeah, so that's a great question, and bottom line is that Amazon is in our portfolio. Amazon does make the cut on JSG criteria. Again, as we said before, we're taking the top 20% of scorers in each sector, and Amazon scores quite highly on jobs, right? They score quite highly on their supply chain management, right? That and their contribution to supply chain management, and AWS creating an environment in which other companies can create website presences and really create digital economy, right? So Amazon does make the cut in a way that sort of a company like Facebook, like we were saying before, wouldn't, even though it's another of these tech mega caps, right? And one of the significant areas, and you raised the G factor, economic growth, right? That Amazon gets dinged on is its treatment of it's somewhat anti-competitive practices that it has, right? When it sort of tries to squeeze small business, right? On the one hand, it creates a platform for small businesses to exist and sell and resell goods that those small businesses would not necessarily have access to without Amazon. Although, in a sense, there are other platforms that do that too, right? But maybe not as big. But at the same time, Amazon does squeeze those small businesses, right? And it does engage in some anti-competitive practices here and there in the way that it does business. And so it gets dinged on those things. Right. But by and large, Amazon has just been, flying colors when it comes to jobs.
Yeah, well, it got us all through the pandemic too. So shout out to them.
There is that.
Yeah. So how quantitative are some of these factors versus qualitative? Like there's such a hard decision, I would think, with some of the nuance.
So it really depends on the individual factor in question, right? And you can actually go to our website, amberwavepartners.com, or the fund website, jsgfunds.com. And you can see right there, in our prospectus for IUSA and also in our website, the specific rubric we use when applying the job score, the security score, and the growth score. And each of them is a multifactorial analysis that's designed to provide a holistic picture of a company's contribution to U.S. jobs, security, and growth. And some of the factors are very quantitative. For example, in the jobs factor, one of the things we look at is the percentage of job growth for a country, for a company, both internationally and in the U.S. over a long period of time. Right. So that's quantitative in nature. But other factors like, the impact of those jobs in the overall labor market draw on a mix of quantitative and qualitative factors, right? So one thing that informs our decision is, relative growth, relative unemployment rates across the U.S., right? So where are jobs needed? Relative growth in real wages, depending on community in the U.S. and across different segments of society, and that informs. We kind of take that quantitative picture and try to map on the company's labor practices into that to come up with a judgment about how critical those the jobs that company is creating is to the overall labor market. And so it's very varied between quantitative and qualitative analysis, but we draw upon both in order to provide what we think is a holistic perspective of a company's contribution on job security or growth.
And another thing that's quite quantitative in what we do is looking at, one of the most important things that we look at is this ratio of revenues in the US to employment in the US, right? And that really gives you, a sense of whether the company is really, sort of creating opportunity in the US for people to have good lives, right? And so if all of your revenue are in the US, but you really don't have any workers here, obviously if every firm did that, you wouldn't be able to afford anything ever again, and the economy would just collapse, right? So that's going to lead to a lower score, right? If you have a ton of employees in the US, but you're actually an export powerhouse, that's great. You're creating jobs, right? That's wonderful. We like to see that, right? And so we can look at things like that to sort of get a quantitative sense. But for the more qualitative things, it's really a relative sense against the other guys in the sector, right? Because like we said before, we're taking the top companies in every sector, the top 20% of scorers in every sector. And so the absolute score, in a sense, isn't really that relevant. It's just about whether you made the cutoff into the portfolio or not. And so you're looking at these companies relative to each other and sort of just trying to give them a ranking, right? And so the ranking is ultimately, the really important thing, and the absolute score itself is less important.
How do balance sheets factor into any of this? I mean, I wouldn't think that they necessarily directly do, but I'm just thinking like a lower leverage profile is arguably more secure because it's more resilient than a higher leverage profile. But I don't know if that actually trickles all the way down to what you're doing or not.
Yeah, what I'd say is it's tangentially related, but it's not. Capital structure is not necessarily the driver of our analysis. So, if, for example, a firm has a high debt load that's going to make it difficult for them to grow moving forward, because most of their free cash flow will need to be dedicated towards servicing debt, it's going to be difficult for them to score highly on some of our other metrics. Yeah. So what I'd say is there's an indirect effect, but it's not an explicit criterion. The other thing I'd say is that for the firms that we're looking at least in IUSA, they're all S&P 500 constituents. So, you tend to see relatively conservatively managed balance sheets. If we were focused on the high yield market, maybe we would more explicitly incorporate it into our decision making.
I was just thinking that like a moderate leverage profile there's probably more job security at that firm is kind of where my head was going, but I can understand why it's not directly related.
No, I think that's
a really interesting
right.
product.
And look, it also depends highly based on industry, right? So, big part of our portfolio, because we're trying to match the broad market, is financials, right? And so obviously you need to think about leverage very differently in that context.
Yeah. Something that I think. So, what's your stance on energy? Is maybe a better way to ask the question. Where does US shale, sort of factor in from a JSG standpoint?
Yeah, so from a JSG perspective, we're really fond of all of the above energy strategies, right? We're supportive of renewables. We think they're important technologies that are going to help the environment and power the global economy and the US economy in particular over time. But there has to be a place in the overall energy mix for baseload power, and just to step back, what baseload power is power that's available at any time, right? Because the sun's not always shining and the wind's not always blowing, and that's got to be provided by fossil fuels or by nuclear. So baseload sources of power are things that we try to look for when we identify, firms in the energy sector, firms in the utility sector that are more JSG friendly, because we think it's important, not just for U.S. jobs, but also energy security, to have the availability of reliable fossil fuel sources.
Yeah, that makes sense to me. Do you guys mind talking a little bit about your time in Treasury? Can we talk about that?
Of course.
All right.
It's our favorite subject.
Well,
no one ever asks us about that.
Well, no, I want to. I really like your product, and I hope that I want to go back to it. But it's just fascinating to me to think about what your life must have been like in February and March of 2020. I mean, when I guess like what was negotiating the airline package like? I mean, what the heck happened in your life when the world sort of stopped? And was it frantic? Was it calm? Like, what was that experience like for you guys, if you don't mind just riffing on it?
So maybe I can tackle that, and I'm sure Steve's got a different perspective, and he'll be able to add a ton. I think in some respects, my experience certainly wasn't that different than everyone else's. The speed with which all this came on was, just the most astonishing thing about it. Because I was in international affairs at Treasury, one of my jobs was flying around the world, meeting with finance ministers, central bank governors, and whatnot. And I was literally on a trip to Europe and the Middle East at the end of February. And when we arrived in Italy, which was the first stop on, I think it was February 21st or February 22nd, our Italian interlocutors were a little freaked out because they had just said that, outside of Milan, the first COVID cases had been reported. And we were kind of like, that's, an interesting data point. And then we flew on to Amsterdam for a meeting of the Financial Stability Board, central bank governors, finance ministers, all around the world. And COVID was, a big topic of discussion, what the economic impacts were going to be, but it was by no means the only. Then we flew to Israel, which was already in lockdown. And then we flew back to Europe, to Brussels, to attend a fintech conference. And everyone there was still shaking hands. Occasionally someone would try to do an elbow bump. So it was very much, business as normal as recently as early March. And then when we landed, that's when the markets really started to go haywire. And anyone who was active in the markets at that time will just remember an incredibly dramatic period. And that's really what our lives were for, the next few months. And so we quickly morphed from, in my case, more from some of the international work that I had been doing to being redeployed, trying to work, all hands on deck to save the U.S. economy. And the speed with which we pivoted and the speed with which we delivered really an unprecedented fiscal support package is just stunning. I mean, the CARES Act, which was $2.4 trillion, came together in basically 10 days. And it's a real credit to Secretary Mnuchin, who was really extraordinary in this period, that he camped out on Capitol Hill and basically didn't leave until the bill got done. But then once the bill got done on March 26th, we had to pivot towards implementation, right? And so in the airline context, which I worked on, Congress provided this big pot of money for us, but there were relatively few guidelines on how we could go spend it. And so there was an enormous amount of discretion and thought and negotiation with the airlines, with industry associations, with taking into account input from Congress and elsewhere to be able to roll out a rescue package that we ultimately announced on, I believe it was April 8th. So just even less than 2 weeks' time, we came up with the entire structure for what was a $94 billion rescue package for the aviation industry and for the national security industry, which is just unprecedented in the speed that it rolled out on. And I do want to emphasize that again. I'm sure Steve will cover it in his discussion of his experiences. The singular imperative in responding to COVID was moving quickly, right? Because you went from an economy that was humming to an economy that was put on life support overnight, essentially. And every day that businesses were closed, that we had lockdowns, stay-at-home orders, was a day where productive capacity in the economy was being destroyed. And so the speed of getting money into people's pockets was really the most urgent, the most important factor in crafting the response. And the government is not, ex ante set up to move that quickly. And so a lot of what we had to do was to get creative to figure out just how we can move as quickly as possible to avoid productive capacity in the economy being damaged.
Yeah, what Dan said is absolutely right about the importance of speed. And, the goal was prevent a depression, prevent a second version of the Great Depression where everyone defaults and every business has to shut down and fire all of its employees, and all of those relationships which create a business right? It's supplier relationships, it's customer relationships, it's lender relationships, it's borrower relationships. Prevent all those relationships from falling apart, because if those relationships are all broken, you can't. It's a bit like Humpty Dumpty. You can't just put it back together again, right? Whereas if you can just sort of put things in the freezer for a few weeks, 2 weeks to flatten the curve was the thinking, right? If you could just put things in the freezer for 2 weeks or 2.5 months, as it turned out, to be in the CARES Act with the Paycheck Protection Program, right? You could just take it out and defrost it and turn the switch back on and get the economy going again, right? So the goal was to get as much money out of the government into the economy as quickly as possible to prevent as many defaults and permanent closures as possible, which meant get the money, out as through whatever creative means you can. Right now, the typical way the government gets out money is through sort of what you would call stimulus checks, right? Which at the end of the day are structured as tax refunds, right? That means they go through the IRS, through the Internal Revenue Service, right? The IRS was busy with the stimulus checks, with the economic impact payments, right? So it was not able to take up the work of getting money to small businesses, right? So we had to structure the Paycheck Protection Program as going through the existing banking system.
Interesting.
Right? And so you've only got so many sets of pipes, and you need to use them all, right? The IRS pipes were full of stimulus checks of the economic impact payments. Banking system relationships are already set up with small businesses. You could get the money through there and get it up and running quickly, and so that's what we did. And there was a lot of criticism of the Paycheck Protection Program after the fact. There were cases of fraud, right? There were loans that shouldn't have been made, but the imperative was to get the money out the door as quickly as possible. And had you stopped and designed a more fraud-proof program, right, and potentially gotten the money out in whatever way you wanted to get it out, whether it's to reduce fraud or whether it's to favor certain groups in the country over other groups in the country, right? Every variation on the rules would have cost time.
Yeah, there was no time. Yeah,
there was no time, right? And the goal, we took a lot of criticism over that, and I feel that a lot of it was unfair, because the goal was prevent permanent closures, permanent defaults, permanent layoffs, prevent a depression. And designing the perfect program would have added weeks or months to the process, which of course you didn't have the luxury of. You didn't have the luxury of that at all. So speed was absolutely 100% of the essence.
Well, I mean, what do you say to people that say like, oh, well, what about moral hazard? And didn't you just bail all these airlines out? Like American was over levered. Why not just let them fail? I mean, what's the response to that?
I would say the economic argument about moral hazard hinges on whether or not you think the change in affairs is permanent or transitory, right? And at the time, the economics apparatus of the U.S. government, by which I mean the Treasury Department, took guidance from the public health community. And the public health community was telling everybody a few weeks to flatten the curve. If we all just stay home, this will be gone pretty quickly, right? And so if you view the shock ex ante as, sort of only lasting a few weeks or at most a few months, moral hazard isn't really a strong argument, because you think the world will return to normal after just a few months. That was the public health establishment view in April of 2020, March of 2020.
The other thing I'd say is that moral hazard is a concern when a particular event is foreseeable, right? Versus in the COVID context, what we're talking about here is a once in a century natural disaster. It wasn't anything that businesses, especially not the airline industry, could have ever been conceivably built to withstand, right? And so the appropriate government response from my perspective, and certainly what we tried to implement, was to preserve productive capacity in the economy, right? Because if you allowed all the airlines to fail, if you allowed all the workers to be laid off, and not stay current on their certifications, putting Humpty Dumpty back together again, as Steve said, it would have incurred much, much, much greater costs on the economy than just trying to freeze these companies in place. Keep that productive capacity online, keep workers attached to their healthcare, keep the employment relationships, so that when you emerged on the other side, you were able to have a much more efficient recovery. I still think that fundamental design was sound. I think there are legitimate questions, across the range of government programs as to how long that support was kept up. including in the airline context, which let's not forget, the airlines received another $15 billion at the beginning of last year, right? In March 2021, as part of the so-called American Rescue Plan that's contributed so much to the inflation that we've seen in the economy over the last year. But ex ante in March of 2020, which was when you had the heat of the panic, I think there was a very strong rationale to say, the moral hazard argument is important, but it doesn't control in this situation.
Yeah, there's a very strong contrast with 2008, right? In 2008, banks had made bad loans of their own volition, right? They'd made too many loans to customers that had no income, no jobs, no assets, right? And then taken enormous amounts of leverage on top of these loans. The preventing moral hazard argument was quite strong in 2008, and we only dipped our toes into it once with Lehman, and even I guess Bear too, and even those were arguable because we ultimately lost stomach and decided we didn't care about moral hazard anyway with TARP and major bailouts facilitated by the Obama administration, right? So we didn't have the moral hazard argument was much more problematic in 08, and we didn't have the stomach to go through with it then. The moral hazard argument, I think, was not really at all, applicable at the time that the CARES Act was being passed.
Well, I followed airlines going into that, so it's something that I know a little bit about. And my point when I would discuss it with people is, I said, there are a lot of union jobs. I think a lot of the airlines carry less leverage than headlines may lead people to think. Like, Delta is objectively capitalized in an appropriate way for an airline. Alaska was objectively appropriately capitalized. Like, you start to get in a scenario where you lose all those union jobs. To your point on the certifications, the FAA is not easy to deal with. And then, what happens if Spirit Aerosystems starts to go down? And what happens if Hexcel starts? The supply chain, to me, I was always thinking, if this thing breaks, I don't know how you put Humpty Dumpty back together again. And it's just an unfortunate situation. It's a situation where you try to limit the pain, right? But the pain's going to be there no matter what.
Yeah, I mean, it's exactly right, and the supply chain point is one that I think is underappreciated. What a lot of people may not realize is that a condition of receiving money under the payroll support program, which is the way that we got money out to the airline industry, was that airlines had to comply with a minimum level of service, which was determined by the Department of Transportation to ensure that supplies, that people were continuing to be able to flow across all of our communities, right? With a particular focus on rural communities where air travel may be the primary way with which goods and services reach those communities. And so that was absolutely a factor in our thinking, right? There was a need to preserve the strategic industry.
Yeah.
But you're right about dealing with the FAA. I mean, think about the approvals, the government approvals and regulatory apparatus that you have to navigate to set up an airline, right? To permission an airline to actually do business. Now, imagine that you lost half or 2/3 of the airline industry in the country, or 3/4 of the airline industry in the country. Setting that back up again from a regulatory perspective, years.
Yeah, I think some people like to say, well, the debt holders would have just taken over, and what does it really matter? I think that's a lot easier to say in a textbook than reality.
So
Absolutely.
yeah, I mean, I agree with that. Although I will give people who advance that argument credit. I mean, the airline industry has demonstrated that people are willing to continue to fly on airlines that are going through a bankruptcy process, and most of the U.S. carriers have gone through bankruptcy at some point, either they or their predecessor firms. The difference here, I'd say a couple. Number one, airlines are able historically to continue flying through bankruptcy and generating cash flow because there's demand for seats on airplanes. In this context, there was no demand out there, right? What you saw is that in a period of basically 6 weeks, the airlines went from record revenues, right, record passenger numbers, to record lows, right? And not just zero revenue, negative revenue in some cases as a result of all the rebates that were happening. And so there are just no businesses that are designed and run on capital structures that can possibly withstand that kind of a shock to the system. And so bankruptcy, an orderly restructuring in bankruptcy, I think was basically off the table. In addition to that, that process would take time, right? I mean, even the GM and Chrysler bankruptcies in 2009, which were some of the most rapid restructurings of major firms in American history, still took months and months and months. And that process could not play out on any sort of realistic timeline in 2020 against a backdrop of the most severe economic crisis that the country's ever faced. There was just too much going on for that process to happen in an orderly way, and there was no cash flow associated with the operations to support a bankruptcy process. The last thing I'd say is, the government is good at some things, but running airlines is not one of them. And so putting the government in charge of operating airlines, much like the government essentially operated GM and Chrysler during 2009, at the most severe point the most severe crisis in an industry's history, is a really bad idea. And who knows what kind of perverse outcomes it could have led to, had the government actually stepped in and overseen some kind of restructuring of the industry during that period. I think it would have been a disaster for taxpayers, and it would have been a disaster for the U.S. economy.
Steve, you had something to add?
No, I was just going to say that, the difficulty of engaging in a bankruptcy process during COVID would have been accelerated by the fact that bankruptcy courts were often closed.
Yeah. Yeah, and the amount of people that would have filed in an alternative scenario. It's like, you're just going to flood the system with bankruptcy proceedings.
Yes, you talk about clogging the pipes. I mean, that was a serious concern. And as it happened, we actually didn't see spikes in bankruptcy because of all the actions that the government undertook to prevent that from happening, right? Small business bankruptcies went down because of the Paycheck Protection Program, right? Large bankruptcies went down because of what large company bankruptcies went down because of what the Federal Reserve was doing in credit markets and in bond markets.
Okay, so now we've gotten through March. Why have some of these actions, whether it's, the Fed balance sheet or whether it's the bill that Dan referenced earlier, like why is it taking so long to wean ourselves off of some of the stimulus and some of the support?
Well, I think a lot of that has to do with what Dan mentioned before with the American Recovery Plan Act from just about a year ago, which, I think was, how do I say it? I mean, absolutely unnecessary. I mean, when this plan was enacted into law by President Biden, vaccines were here, right? You think about fiscal stimulus being appropriate, only when monetary policy has already done everything that it can, and then appropriate in a countercyclical manner when the economy is going down and there's sort of a giant output gap and it won't heal by itself and it needs the fiscal authority to step in and spend in order to get the economy back on its feet. The ARP was the opposite, right? Vaccines were here. Things were beginning to reopen a year ago this time. The economy was coming back to life. There wasn't even any concern about Delta or anything then, or let alone Omicron, right? So this was fiscal stimulus at exactly the wrong time in the economic cycle. This, counter-cyclical policy is supposed to lean against the wind, and this was leaning directly into the wind. That's why we have a lot of the inflationary problems that we have today. Obviously, it's not responsible for all of the inflationary problems, but, it was a significant contributor at a time when there were several other significant contributors. And, it's created an environment that, sort of has had a toxic combination of inflation from domestic and international sources.
The one thing I'd add is unfortunately there is a political overlay to all of this, right? And if you look at what was done in 2020, when Steve and I had the honor of serving, every single COVID response bill, whether it was the CARES Act or whether it was the final piece of legislation that we were involved in, which was the year-end bill in 2020, was done on a bipartisan basis, right? I mean, these are bills that passed the Senate, 99-0 in some cases. The American Rescue Plan, however, was a pure party line vote, which I think indicates that it may not have been what was widely recognized as necessary fiscal policy at the time, but instead was part of a broader political calculus with the changing of the guard in Washington. And it's unfortunate that we ended up in that position, right? Because you certainly want to see most economic policy done on a bipartisan basis, and I think the whole country has been paying the cost of that largely in the form of inflation over the last year.
Sometimes when I see those partisan votes, I wish that we could do like a blind vote where everybody thought they were the swing vote. Right? Then I think you would actually get to like a true outcome. But that's idealism, I suppose.
That'd be funny to watch.
Yeah, right.
But even the bipartisan infrastructure framework that was passed last year, right? Even that's going to contribute to inflation because it's arriving at the wrong moment in time. That's what should have been passed before ARP for sure, not after ARP. But if you think about infrastructure spending, yeah, the country needs infrastructure spending dearly. There are places in the country where infrastructure is falling apart and traffic is horrendous, and you need to create transit options for people to move around the country, or else you can't really keep the economy functioning. That's absolutely necessary. But nevertheless, in the long term, maybe it can be disinflationary as it reduces wait time and increases the ease with which people and goods move around the country. But in the short term, at least for the first few years, it's going to throw more inflationary fuel on the fire at exactly the wrong moment. Think about road construction, right? And I wrote about this in the Wall Street Journal last year, right? When construction happens, after construction is done, everything flows much better. Traffic goes down, right? You can think of traffic as inflation, right? It's increasing the cost of going someplace. And so after construction, traffic goes down, everything functions more smoothly, it's disinflationary. But we know construction can take years to occur. I live in New York City. The East River Drive near where I live has been under construction for like 4 or 5 years, I think, at this point, and there's still no end in sight.
Yeah.
So, and while the construction is happening, traffic is much worse.
Yep.
When they shut down one lane while they're building additional lanes, traffic backs up. Building of new infrastructure tends to disrupt the usage of old infrastructure during the building process.
Mm-hmm.
That can throw fuel on the inflationary fire. And so even though the bipartisan infrastructure framework is going to be disinflationary on a 10-year horizon, on a 2 or 3 year horizon, right? And don't forget, the spending is starting in size, later this year. On a 2 or 3 year horizon, it's just going to be even more inflationary.
At exactly the time where we have commodity shortages.
At exactly the time when you have commodity shortages, and at exactly a time when essentially what you're doing is you're forcing the Fed to hike even more to offset it. This notion of monetary offset of what the fiscal authority is doing. The Fed is targeting a particular inflation rate, and the more the fiscal authority drives that inflation rate up or down, the more it forces the Fed to try and counteract it. So the Fed will have to hike more than it otherwise would have because of this.
It's very confounding how the Fed can get any control of the current inflationary environment without hiking enough to really put the brakes on the economy, because to me, it seems like a supply side issue between supply chains and commodity shortages. Now, maybe that's because the demand is too high. I'm not sure, but boy, what a problem it seems like we're facing.
Absolutely. I mean, the Fed has really tragically painted itself into a corner where there's no good options. I mean, the policy error was really done a year ago. The tightening should have begun a year ago, not now, and they should not have been doing QE until March. I mean, the idea, they didn't start tapering until QE until like November or something, right? And the idea that in September of 2021, you needed the same exact policy settings that you needed in April 2020, as though the economy hadn't changed, is just insane.
Yeah, so why does that
just
happen?
Bizarre.
Like, they're smart people over there. Like, why do they continue to do what they've been doing?
I mean, I think it's a little bit of a French influence. They're fighting the last war. And, like the joke about the French are always fighting the last war. And in the previous, sort of last 10 years, 15 years, right? Recoveries from recessions had been slow, they'd been difficult, and they'd been disinflationary, right? Those were very different types of recoveries. The previous 2 recessions, 2008 and 2000, were caused by the collapse of asset bubbles. So those were really what economists call balance sheet recessions, where there was too much debt in the economy, which had misaligned balance sheets. And so people with bad balance sheets spent years saving saving lots of money to pay down their debts.
But this week actually came out and everybody's, well, not everybody, but the consumer balance sheet was recapped positively.
Exactly. After 2000, it was corporate balance sheets. After 08, it was consumer balance sheets, household balance sheets, right? But in 2021, this wasn't caused by an asset bubble collapse, which left people with bad balance sheets. It was caused by a natural disaster. And the natural disaster went away, and we recapped everybody much more than anybody lost through fiscal. So the idea that this recovery was going to be as slow and horrible and disinflationary as the last one is just rooted in a naive recency bias. And I think that's the problem that the Fed ran into, not really understanding that every recession is different, and the policy mix you need for every recession should also be different. And so the idea that in September of 2021, policy was on the exact same settings as it was in the summer of 2020, when the economy was so much different, the unemployment was so much different, the public health situation was so much different, is just, frankly, I think, just nuts. So whether it was a supply side issue, I mean, yes, the supply side has contributed, but I do think it's really important to draw a distinction between the commodity shock and the supply chain disruptions. I think because they're quite different. And the commodity shock is more of what economists would traditionally think of as a supply side disruption that you should look through, right? That a monetary authority should look through because it's transitory and whatever, right? So that's much more recent. The oil price really going bonkers. The supply chain disruptions, what they do is rather than sort of shift the supply curve of the economy inward, they just serve to make it more vertical. So if you sort of picture a supply and demand chart in your head, a more vertical supply chain means any increases in demand just result in inflation.
Yeah. So said differently, you're not the supply. How am I trying to say this? I think I know what you're saying. It seems like the quantity supplied right now is artificially low. The supply chain theoretically hasn't changed, but there's practical constraints to it. And then demand has actually shifted up. So you've got like a price explosion to get to equilibrium.
Exactly. You're at max capacity. No matter what you do, you just can't produce more.
Yeah.
The widget factory is working at full capacity. There is no ability to produce additional widgets. Any additional dollar of demand, therefore, cannot show up in more widgets produced. It can only show up in the price of widgets.
So going back to JSG, do we need to have a more do we need duplicative supply chains? Like, do we need a more robust sort of workaround in case the supply chain gets, sort of cogged up?
Well, we need more resilient supply chains for sure, 100%, right? That means supply chains that have less exposure to the potential to get all tangled up, like involvement in, sort of parts of Eastern Europe that Vladimir Putin might want to fence off and add to Russia at any moment in time. It means more safety in exposure to China, because China could wake up tomorrow and decide there's some internal argument in the Communist Party, and your key supplier of parts has fallen victim to some internal Chinese political squabble, or trade war tensions could escalate. And it means more exposure either to the US or to stable and friendly countries that are near the US.
Yeah.
And on top of that, it means less of a just-in-time management of inventories. The just-in-time inventory chain worked marvelously in a world with no shocks and endlessly increasing capacity. But what we've learned is that it's just not robust. It's not resilient. And so supply chains need to be, they need to have maybe some redundancies built in, but certainly steps need to be taken to make things more secure.
Dan, you have anything to add?
No, I couldn't agree. I mean, the whole paradigm needs to shift from just in time to just in case. And we believe that, over time, companies that adopt that model are actually going to optimize over a long enough time horizon for the security of their supply chain, and therefore the financial performance of the business. Because just in time may work as long as there's no geopolitical shock, but there will be. And so over a long enough time horizon, if you're an investor with a long time horizon like we are, you really need to incorporate that kind of thinking into your business model.
We're really in the early innings of the reshoring movement, right? There's just so many reasons for companies to be doing that, and the companies that are specializing it and getting a head start, we think are going to deliver, significant outperformance in coming years.
Yeah, I think we're like in the top of the first inning, right? I mean,
absolutely.
I think it's just been a crazy couple years to live through, and to have, I again, like I don't pay much attention, mostly because I'm not very intelligent when it comes to geopolitics. But like, to see how the West aligned around when Russia attacked Ukraine, to see how the West got united on the back of COVID with all these supply chain issues, I can't stop thinking about like how much risk is in the supply chain system right now, and how that needs to be taken out of this. We need to reduce that risk every day we can, I think.
And that risk,
but maybe I'm wrong.
No, we agree with you. And that risk, in the Russia-Ukraine context, is much more limited than the risk is in East Asia. If you take the semiconductor industry, for example, I mean, this is maybe the area you see it most acutely. I mean, our entire economy is essentially dependent on TSMC's ability to continue to operate and supply iPhones, and various other semiconductors across our economy. There's also a real concentration risk to Samsung in South Korea, and the neighborhood is not that friendly, particularly as you see revisionist China looking to impose its own view of what the world order is likely to look like. And so, just to frame up kind of where we are in this reshoring process, as you said, Bill, we're really only in the top of the first inning, because the announcement that one of our portfolio companies, Intel, made a couple of weeks ago about investing in this new campus of fabrication and design facilities for semiconductors in Ohio is wonderful, but it's going to take years, right? The TSMC factory and the Samsung facilities that are being built in the southeast right now, or excuse me, southwest in Texas and in Arizona, are wonderful, but it's going to be many years before those foundries are active, right? And so we're only at the very beginning of the process. And in the interim, it's critical that we, continue that diversification, but also defend the current supplies that we have in the market, because, what we've seen in the auto industry, for example, the industries can be very, very, very sensitive to shocks in semiconductor supplies.
I mean, really, the losing of the narrowing of the American technological edge over China and other adversarial countries, and the hollowing out of the American industrial base, that happened over decades.
Yeah.
It really was a slow process from from the fall of the Iron Curtain on, right, to China entering into the WTO, all the way until COVID, when suddenly we couldn't attach plastic loops to pieces of cloth to make masks, and we had to import them from China.
Yeah.
I mean, like that's crazy, right? And rebuilding that technological base, rebuilding that industrial plant isn't going to happen in 6 months. It was multi-decades to get to where we are now, and it's going to be multi-decades to get get back on top. So, we think that the companies that we choose are going to benefit from really multi-decade secular trends in these areas.
Yeah, and when we think about kind of the role in the health of the overall U.S. economy and the growth factor in JSG, one way to think about this is in the context of spillover effects, because innovation happens where production happens, right? And so It's so critical for the U.S. to have this manufacturing base so that we can continue to be on the technological edge over a multi-decade period.
100%. It's funny. I was watching. It might have been on Discovery Channel. I don't know, but they were talking about how expertise is in geographies, and the case study that they were looking into was glass blowing in Venice, Italy, right? And the way that expertise from the people that are using their hands gets transferred up to the whatever it is. I think, well, if we're not close to making anything, how are we, like, I get that, okay, we have the brain and we're sending the prints or the blueprints over, but like, there's almost a disconnect that I think creates this risk of getting bypassed. I don't know.
Totally. Couldn't agree more. I mean, in order to figure out how to make things better, you have to be making them to begin with. You need to have your hands in the dirt and to have real experience about how things work in the field. It's the difference between the map and the territory.
Yeah.
And it's one thing to sort of sit around planning a battle or a travel line or something like that using a map, but guess what? There's bumps in the road, and that you didn't expect there to be because they weren't on the map, but they're in the real world that you live in. So in order to really have a technological advantage and maintain technological supremacy of the United States and industrial strength of the United States, you need to be innovating, and you just cannot innovate if you're not making anything. Otherwise, you wind up with a company like Facebook employing the best minds in the country. And given a choice between a country in which the best minds were creating social networking tools, or a country in which the best minds were curing cancer, or building robots that take care of your grandparents or whatever it is, right? I would rather choose the country that has the best minds making stuff, instead of building what at the end of the day are sort of great social tools, but in my opinion, have limited physical impact on human welfare.
At least positive physical impact on human welfare.
Yeah, I mean, I have I've used Twitter to educate myself on a lot of things, so I think that there's merit in what they do, but at the end of the day, it's a media company, and to think that the brightest and best and brightest or whatever are going to work in media is kind of a terrifying thought.
Absolutely. Look, the media companies and the social companies, right? Like, the products are valuable. They have functions in society. At the end of the day, I'd rather have a society with these products than without these products. But I'd still rather have the best minds curing cancer.
Yeah, no doubt.
Yeah.
I mean, what Palmer Luckey is doing, right? Isn't that the guy that started Oculus?
Yep.
Yeah, what he's doing in defense is pretty cool. There was just an article on him in Wired. I don't have a problem with the bright minds doing stuff like that. That makes me feel more secure.
Yeah.
So, well, I tell you, I mean, do you guys want to talk about anything else? I've loved this episode. I might have to play like "My Country 'Tis of Thee" as the intro music or something from it.
Well, we're just trying to make it a better country for everyone who lives here. We think it's great that corporate social responsibility has expanded in recent years to encompass ideas like the environment, right? But we think at the end of the day, corporate social responsibility, your number one responsibility is to make the country you live in a better place for everyone who lives here. And that includes jobs, includes security, it includes growth. And so we encourage people to visit our website, amberwavepartners.com, or the fund website, jsgfunds.com. Learn more. Feel free to get in touch with us. If you have a financial advisor, tell your financial advisor about JSG Investing, because we're in it to improve life for everybody. And in order to do that, we need to make JSG Investing work.
Dan, I'll let you wrap up. But one thing that I wanted to circle back to is something that you said about investing in rural communities, because I don't know how many people get in the car and drive anymore, but I drove from Chicago to Denver, and I drove from Chicago to Florida. And, it's sad. You see these towns that like things used to go through, or they used to make things, and it's devastated, and I was talking to my wife. I said, what's the probability that this town has an outlook that's better in 5 years than even this one? And, I am hopeful that onshoring and funds like yours incentivizing the right behavior may give those people a shot again, because they deserve it.
I mean, we're certainly hopeful as well that the trend can turn around. I mean, just to kind of back up and identify the driver. I mean, there's a reasonable economic argument if all you're looking at is utility or productivity or other measures of output, that trade displacements, right? You're buying things cheaper from China or some other market. Labor that previously produced that will be reallocated elsewhere in the economy, and on net, everyone's going to be better off as a result of the greater productivity and the cheaper cost of goods. But that has a very, very narrow, that economic view is a very, very narrow one. And what it doesn't take account of is that people don't work for the economy works for people. And so what you saw as a result of some of that thinking is that certain segments of society, the burden fell on them disproportionately as, what the industries that previously produced livelihoods for many American communities moved elsewhere. And guess what? There wasn't enough help for those communities. And what we've seen is in economic theory, that wasn't even a positive, right? Because of the supply chain vulnerabilities it created, because of the harms to U.S. Energy independence and other forms of economic independence. So really, what we need to see is a broad rethink of the philosophy that led to that process, and the capital markets have a role to play. Right, ESG has had a dramatic impact on the availability of financing for the energy industry, for example. And JSG is just starting, right? I mean, IUSA, our ETF, is just starting out. We only launched in January, but over time, we want to grow this into an ecosystem that can help bring some balance back into the capital markets to make sure that we're remembering, broad-based impacts on American communities from corporate action.
Well, I'm rooting for you guys. I thank you for stopping by the show. And if you ever have some big thoughts on the Fed or Treasury or anything that you want to share, open invite to come back on. So thank you guys, and I look forward to watching your progress, man. Or both of you. I really am hoping for good things for you because I think it'll be good for our country.
Great. Well, thanks for having us on. It's been such fun to talk with you.
Take care, Bill. Thanks again.
Absolutely necessary. But it's absolutely